Alibaba has released its new earnings, and the market is not positive. While the earnings were okay, the news that Jack Ma is gonna sell some stock is affecting it. But I think that is short term. Long term, we need to look at the numbers. We can see growth was fairly slow, 9% growth only, and here you need to understand how Alibaba is structured. The slow growing segment is the Taobao and Tmall group, which is their main China segment. And that thing only grows at 4% right now. This segment is mature. The other segments are faster growing, except cloud, but I'm not looking that much at cloud on this company. And here's where they make most of their money. So if a segment only grows 4%, that means their main cash cow is not growing as fast, which is a big issue. Now, international is shining with 53% revenue growth, but it is not profitable. I look more at their logistics segment, which is still growing fairly good and is also EBITDA profitable. We can see they're focusing more on profitability now. The margins in the logistics segment are improving a lot. So on the local services, the cloud, digital media, and all the others. So we can see overall Alibaba is not in a growth streak anymore. It is now focusing on becoming more profitable. Plus they're reducing share-based compensation, which I like to see a lot. And not only slow, they're reducing it fairly fast. The only thing where they're not becoming more profitable is the fast-growing international segment. I think here they're not gonna focus on profitability yet because it is still so fast-growing. But I think eventually they will also focus more on profitability here. And we can see Alibaba is just becoming a cash cow. Yes, their free cash flow was much higher this quarter than last quarter, but that is not due to high operation cash flow. That is due to them halving the capex. So don't look at this as the continuous growth. This is a one-off. Now they are still buying back shares, but you have to remember they're also having share-based compensation. They had 930 million in share-based compensation. So this 6.1 billion free cash flow is only around 5.1 billion to take it conservatively. So their buyback program is not as big as it could be. And they're also starting to pay out a dividend of $1. That is not a lot, but they just have so much cash they don't know what to do with it anymore. They have a net 62 billion in cash right now. Their market cap is 221 billion before the stock went down 8%. And if we now look that they have around 20 billion in free cash flow taken on the year, net stock-based compensation, we come to a multiple of around 11. But if you deduct the 60 billion from that, because the cash pile is still growing, it's not that they're using this cash pile to buy back shares or something, the cash pile is increasing, so net cash, this is around an 8 multiple. This is a very fast growth in net cash. I expect them to either increase the buybacks or increase the dividend. I mean, if we just look at the cash pile increasing by around 50 billion yuan, they bought back 11 billion in shares. They could have 5 times that, and they would have still not used any of the net cash they have. Now we look at how much cash they're giving per share. We determined they make around 5.1 billion in free cash flow. They have 20.5 billion shares. However, that is for just the normal shares. One ADS, which is what you buy when you buy Baba, is around 8 of those. You come to around 2.5 billion. That is around $2 per quarter in free cash flow per share. So now I look at valuing Baba. If we assume they're gonna grow at 10% for the next 5 years and 8% after that, that includes some revenue growth, but that includes mostly just the segments becoming more profitable. Because while the main cash flow business is maybe growing at 4 to 5% for the foreseeable future, the other businesses, which are faster growing, are slowly becoming profitable. 10 discount rate, 13 multiple. For a US stock, that would be fairly low, but this is a China stock. There's a risk. I want to be conservative. Well, then we come to an intrinsic value of $98 per share, which is above the current value, but the cash on hand is $24 per share. And either they will use it to buy back shares at these low rates or pay out as a dividend. So I want to just have it in the calculation here. In that case, we would come to an intrinsic value of $122 per share. Now, what if they use more cash for buybacks? Let's say 12% growth rate. Remember, they can easily do this without depleting the cash pile and it's still growing. And it gets a slightly higher multiple. Well, then we would come to $130 per share. Plus the $24 cash in hand would be $150. And it can also go worse. What if growth basically nearly disappears? Only some buybacks, only some cost reduction, 10 multiple, $52, plus the $24 cash on hand, that would still nearly be a 10% return. I'm thinking of maybe adding Baba back to my portfolio, but as a very small position, nothing above 10%. It has so much cash, so much free cash flow. The only thing that can really go wrong is China invading Taiwan or something. But I think that risk happening since the Ukraine crisis has been greatly reduced. What do you think about Alibaba? Write it down below. Have a good day.